Hi, good afternoon, everyone. My name is Jatin Agarwal, and on behalf of ASK Investment Managers, I welcome you all to the quarterly update on ASK Indian Entrepreneur Portfolio, better known as ASK IEP. We know that the Q3 earning season is behind us, and once again, it's time to welcome Mr. Sumit Jain, who is the Deputy CIO at ASK IM. Sumit has an experience of almost 2 decades in the Indian equity markets, and a large part of his career has been with ASK only. He has been managing India's largest PMS strategy, ASK, with assets under management close to $2.5 billion right from the start. Uh, Once Sumit is through with the quarterly update, we will open the floor for question and answers. Sumit, thank you so much for joining us, and the floor is all yours.
Sure. Jatin, thank you for the introduction. Um, uh, and I welcome everybody on this call, on this quarterly webinar of Indian Entrepreneur Portfolio. This is a good time to discuss how has the performance been for portfolio companies. What is it that we kind of expect from the portfolio? So before I come there, uh, I'll first get into what has been the macro backdrop, be it global, not as much Indian, but some things that actually can impact portfolio as a whole. So this is something I'll kind of start off with, and then we'll get into how has the quarterly performance for India Incorporate been, because at the end of the day, markets are barometer of how does the earnings shape up. So with that, let me kind of get into uh, the key change that can have impact on the valuations. See, one thing that we believe will play out in markets is the effect of, or rather the after effect of falling inflation in the world. Uh, Clearly, you can see how world inflation is sliding down. It used to be in the 2% range in the past. Now it's from reaching highs of about 5% plus. It's closer to about 3%. So clearly, there has been a fall in inflation globally, and this has had effect on the rate actions by Federal Reserves, or the reserves central bank of the world. So US actually has stopped hiking rate. Europe also has done that, and that actually can have implication on cost of capital. In fact, the expectation is that Fed fund rate, which is between 5.25 to 5.5% at the current point in time, should reach closer to, or a percent drop in this rate in this calendar year, by the end of this calendar, is a possibility. So what does it mean for the equities? Clearly, in the past, when interest rates have actually been um, cut, we actually saw impact on markets, not positive but negative. So to that extent, the drop in interest rates were not an antidote to the profit pain that we saw in 2001 or 2008 in terms of fall in interest rates. So it's vital at the current point in time that what are the kind of businesses that we own? What is the execution prowess of the management that we own? Do they have ability to increase market share? This, I think, will play a very important role in the overall value creation, because this drop in interest rate actually, uh, to a certain extent, is also because global growth rates aren't really great, and inflation also has started to turn around. But this has a very important implication, at least on the kind of businesses that we own in the portfolio. Most of the businesses in our portfolio, uh, by character, are very solid businesses, and their cash flows are, or pretty long dated cash flows, have been discounted into present value. And when we actually see cost of capital going down, these businesses typically would see relatively higher positive value change in their overall computation. So, which is why if our if our companies continue to perform, and we believe the longevity is really there, then this impact would be over and above the positive impact that we should kind of envisage. So this is one change that we believe should happen. Another thing which is happening at the current point in time, and this is relatively more shorter term, and one needs to bear that in mind, is after seeing the sharp increase in freight rates globally, uh, post COVID, wherein if you, this is an index of cost structure, wherein what's the cost of moving one container from China to US East Coast. In the past, it used to hover around $2,000, 2000. Peak of COVID, it reached 22,000, and then it came back to around those 2,000. Today, it is up 3x, or rather, it is up 2x. So it's almost at 6.5 from 2.2 to 2,200. So it has been a sharp increase. And this certainly would have some implication on the global growth rates, how logistics will also play out for businesses which are on the export oriented side. But we believe this is going to be more hopefully this uh, is not doesn't play out over a long period of time, and things kind of settle. Sorry. With that, let's get into how has the quarterly performance been of the markets of our portfolio companies. That's vital because it's a good time to look at the performances. Very interesting behavior. Um, for India Incorporate, revenue growth was any which ways impacted for a while. If you look at revenue growth for BSE 500, in quarter one, that was close to about 5%, and it still remains close to about 5%. But profit growth actually has started to come down. For 2 quarters, we saw operating profit growth of about 29-30%, and obviously profit growth at 40 to 50%. Now, this quarter, we saw operating profit growing close to about 14.5%, closer to about 15%. Next quarter, if revenue growth doesn't accelerate, we believe that the base will start to become a lot more difficult, and profit growth for India Incorporate actually will start to look lower. And which is why it is imperative that we focus on businesses where revenue growth is really strong, and that those kind of businesses would actually be able to differentiate in terms of profit growth versus the market as a whole. So top line growth to our mind will play a very important role as input price tailwinds have started to wane away. Now let's look at how has the sectoral composition been. Um, if we start off with consumption, we have close to about 1/4 of our portfolio on the consumption side. And pretty decent part of our portfolio is on the discretionary versus the staple. At an aggregate level, numbers have not been great on the consumption front. Staples numbers have actually been pretty weak. In fact, what I would say is numbers have stabilized at the lower level. In fact, if inflation starts to remain low, we may start to see improvement in the trajectory for staples. On the discretionary side, it has been a very mixed one. Quite a few businesses, whether those have been more marriage related stuff or actually have seen, or QSR have seen pretty weakish numbers. But there has been businesses like jewelry, businesses like tourism, actually performing really well. And we own businesses which are on tourism or jewelry part of the market. On the tourism side, we believe the consumption patterns are changing. Government obviously is playing its bit, but in general, the move towards experience would mean tourism actually should do a lot better over next many years. And this is the entire ecosystem. If we think about number of aircraft, number of airports that this country has, in 2004 we used to have about 70 plus airports. Today, this number is 140 plus, and over next few years, we should go to 200 plus. So this is just one factor which is driving. But other than that, when the entire ecosystem does well, airlines, the entire hospitality industry, the players who are in this ecosystem like travel agent, many of them starts to do a lot better. So we believe aviation should do really well. And then there are other areas as well which should play out over next many years. Discretionary consumption as a pact, we believe is one area where opportunity is immense. And as we see income level increasing, many of these will do a lot better. Consumer durables, we already started to see improvement there. This industry was impacted for last 2 3 years. This is a period where we are seeing improvement in their rate of growth, and also base is also favoring, but there is a huge under penetration that's there in this industry. So we are starting to see some stabilization in staples, some mixed behavior in discretionary, and turn in quite a few areas of the consumption. Now let's come to infrastructure and engineering, which is very vital. Last many years, market actually were have been moving more on the consumption side. Last few years, infrastructure investment kind of businesses in the marketplace have done well. But there has been a very interesting trend here. At the current juncture, what's happening is this part of the market actually has been driven more by government. So businesses like defense, businesses like railways actually are flush with orders, and uh, their numbers have actually been pretty decent. On the private capex side, numbers are still lot to be desired. Consumable businesses, bearings, abrasives, material handling, logistics. Uh, we are yet to see pickup there. So private capex cycle is yet to pick up. But given the fact that supply side is now a lot better as compared to what it was in the past, we believe it's only matter of time that private capex cycle also starts to pick up. Real estate pre-sales actually have been very strong. Um, and this is again a factor of the relatively impacted space for last many years, and we are now seeing some bit normalization there. Coming to what is government trying to do here? So in the interim budget that we saw gone by, uh, overall capex is has the expectation is that it will grow close to about 17%. While on the headline number in FY24, the budget estimate was almost 10 lakh crores in terms of total capex. We should end with almost 9.5 lakh crores of uh, the capex that would be done in this year by the government. So about 17% growth, pretty decent focus by the government on the capex front. And we believe this area would see continued investment, and private side will start to follow. So if it was largely about consumption in the past, now we believe it is consumption plus capex, both will fire. Automobile, pretty strong performances. Um, Incidentally, most of the areas, whether it is two-wheelers or passenger, both have done well. Even commercial vehicle segment is doing well, while there may be some bit lull going forward in that area. Uh, but at an aggregate level, I think autos as a space should continue to do well. Not only would their volumes, or not only have their volumes been decent, they are tracking pretty well on the profitability front as well. Their margins are significantly better as compared to what they used to be pre-COVID. So in spite of some areas where volumes are lower than what it was versus, in the pre-COVID, margins are a lot better. So this talks about the ability to extract more profits from the business. I believe this is again another area that should continue to do well. In fact, on the two-wheeler side, while industry has still not reached what it was pre-COVID in terms of numbers, or 2018 when it kind of peaked out, we believe we should see demand which is more replacement demand, which is now coming into the system, and a relatively decent growth should continue given the fact that two-wheeler at an aggregate level is past due the replacement cycle. Healthcare, pretty interesting stuff is happening. Hospital businesses are doing well. Domestic pharma kind of businesses, they are pretty stable, and we should continue to see stability here. On the international front, we are seeing US generic cycle actually being a lot better. Rather, the price erosion, which was at a very rapid pace, the rate of erosion has reduced. So we have exposure towards um, Torrent Pharma in case of domestic pharma business, and we believe that should continue to grow really well over next few years. In fact, they have shown their ability to increase market share. They have actually been growing at a rate faster than what the overall domestic pharma growth has been. On the international piece, we have business like Dr. Reddy's, and their performance also has been pretty decent. Coming to some of our portfolio companies, especially with respect to these areas, on the consumption, in case of staples, we have Patanjali, and revenue growth, while it was decent, margins were impacted. But we believe margins were impacted more because of mix, and those should normalize going forward. We believe their food business should grow pretty decent over next many years. And at the current juncture, it's already among top 7, 8 companies in the food business in terms of size in the country. So we believe that is one area that should do well. On the airlines, Indigo performance was superlative. They continue to stack up really well. Businesses like Titan also delivered great set of numbers, and interestingly, jewelry as a pack actually did well. One business which has not done as well, which was Page Industries. Their business still is impacted, but we believe that as industry itself sees normalization, they should start to come back. Overall, we believe they have marginally gained market share when we look at the industry. On the infrastructure and engineering side, we have businesses which are more into manufacturing arena, or rather more into structural steel kind of business, APL Apollo. Volumes were impacted during the quarter, but this is more a quarterly phenomena. Over next 2 years, we believe this business should grow their volumes at least 20-25%, if not higher, and profits actually at a rate much faster. This business actually is a beneficiary of the infrastructure investments that the country is witnessing, whether it is more number of bridges, more number of hospitals, right? That will lead to positive impact on the structural steel industry in the country. Similarly, JSW Infrastructure, which is the port business that we own, that business has stacked up really well. And this is one area where it's going to remain a very concentrated one. And as our as our manufacturing starts to do well, our our trade would also be a lot higher. And consequently, most of these ports, which are dominant ones, actually should do a lot better. Coming to financials, in general, NIMs for banks actually saw a bit of moderation while this was expected. But at the same time, this pressure on NIMs actually can persist for some more time as the liquidity is tight. And this pressure on NIMs actually has led to slowdown in their overall net interest income. And OPEX has remained elevated. So overall, banks saw mixed set of performances. Our focus, if we look at our portfolio, we have relatively higher exposure towards NBFCs. And when we look at the performance there, it actually stacks up really well. While there has been some increase in provisions, but in general, overall growth has been upwards of 20%. Bajaj Finance grew their AUM upwards of 30%. Similarly, Chola grew their AUM upwards of again 30%. NIMs, much like banks, were impacted a bit, but not as much. Going forward, we will still believe that NBFCs are better placed than banks, and we have a relatively higher exposure towards NBFCs as compared to banks in our portfolio. Coming to what has been the aggregate performance of our portfolio versus what it is for Nifty 50. Overall, our portfolio companies grew revenues at close to about 14% and profits at close to 20% for this quarter. Year as a whole, we expect profit growth of 25% plus. So this year gap is not very high. Incidentally, we expect next year actually gap to increase pretty meaningfully. As we just talked about the fact that input-led tailwind for most of the businesses should start to recede. Top line growth actually will start to make a significant difference. Our portfolio companies, we expect top line growth to sustain, in fact, slightly accelerate. While for markets, they should kind of sustain. So the gap increases pretty meaningfully, and that should translate into differential in profit growth as well. And the way we have always approached investing is focusing on right kind of businesses where profit growth is superior, and that superior profit growth is backed by a very high capital efficiency, and both stacks up really well for the portfolio. Coming to what has been our actions in the portfolio over last 6 months, we introduced 5 names by and large in last 6 months into the portfolio, and these are from varied areas. One of the name is from pharma, another one from aviation, then ports, manufacturing related business, auto, and we exited out of Aarti and Kotak Mahindra Bank. So those have been the large actions in the portfolio in last 6 months. Coming to our positioning, how are we positioned versus markets as a whole, and how has this position changed? Consumption remains relatively higher overweight, and on the consumption side, we have relatively higher exposure on the discretionary side. We believe, as we just talked about, discretionary is where we believe long period growth should translate into. Similarly, we have higher weightage towards healthcare and all sort of healthcare, whether it is domestic, whether it is international. And we believe this is area where we should see continued profit growth for a length of time and environment getting better. So these are our 2 relatively larger overweights. And another overweight in the portfolio is about some bit of telecom businesses, where we believe now is the time where cash flow growth actually will be way higher than profit growth, while revenue will continue to accelerate, driven by increase in ARPU, market share gain. Given the character of these businesses, where relatively higher share of revenue growth translate into profit, close to about 2/3 of incremental revenue translates into profits. Right? So which is why we believe that profit growth will be higher than revenue growth, and the fact that capex has virtually kind of peaked out, we believe that cash flow growth will be significantly higher than profit growth, and which is why we have been having a decent exposure towards telecom businesses, and that should continue to do well. We are underweight quite a few global businesses. When I say global businesses, it could be IT, it could be global commodities. Our confidence on India growing relatively higher for a longer period of time is high, and which is why relatively higher focus on domestic businesses. Coming to portfolio psychographics, how does it stack up? How does it stack up versus markets? Clearly, way superior earnings growth, way superior capital efficiency, close to about 35% plus ROCE for FY24, and that only gets better. PE actually has seen significant compression. At the current point in time, portfolio PE is 30 times, roughly 32 times, while for markets, this should be closer to about 19-20 times. So while we may be premium on in terms of PE versus the market, but this is backed by a way superior revenue and profit compounding, and way superior characteristic of the business, way better quality of the portfolio. So if there is anything, with respect to uncertainty that crops up, it's the character of business quality of business, that actually starts to make a significant difference. Coming to how is this portfolio positioned and what has impacted the performance. Um, this is a this is a business or portfolio which focuses on family-owned businesses, and family-owned businesses is close to about 55% of the overall benchmark. Um, when we look at how benchmark has done, and PSU basket actually has done dramatically well. While it average weight for PSU was about 10%, it almost contributed to about 7% total returns to the portfolio. So to that extent, there has been a vast divergence in terms of how the performance across different ownership pattern has been. We really believe entrepreneur as a pack have done really well over a long period of time. They have strength. And when environment gets better, which is the case at the current point, when we see broad basing of opportunities, a lot of entrepreneurs actually do come up, and over a long period of time, it's entrepreneurs who actually have done significantly better as compared to many other ownership patterns. So, which is why a focus on right set of people who have ability to increase this their market share positioning should result in significantly better portfolio performance over a long period of time. This is the portfolio performance. If I look at performance on a calendar year basis, we have outperformed on 10 calendar year out of the 14 calendar years, and last 2 years of underperformance has largely been because of some part of the market which has actually done well. Family-owned businesses as a pack actually underperformed the benchmark, as I just discussed. Given the kind of strength that these businesses have, given the kind of opportunity, our confidence on promoter-owned businesses remains very high, and we believe it's only a matter of time that it starts to regain that outperformance. Jatin, I'm open to questions.
Thanks, Sumit, for such a detailed presentation and overview. We have few questions. One is from Mr. Kumar, who says that why are footwear operating margins and PBT shrinking?
Sorry?
Why are the margins of footwear industry, that is operating profit and PBT, shrinking when India is growing?
Uh, that's a very interesting one. In fact, frankly speaking, it's not only in the footwear arena. If you look at industry which Page is into, innerwear, even their industry as well has declined, and so has footwear industry as well. Overall growth actually has been pretty minuscule, or rather it has not been up to the mark, and that has led to impact on margins as well. So I would think this is more of a phenomena which can't continue for a length of time. Over period, as we see deeper penetration, we should see many of these industries starting to do a lot better.
There is one more question that is from Mr. Prajapati, and this is on global economy. So he says that there is a 34 trillion dollar debt on US, and yearly servicing cost is around 1.5 trillion dollars. Will rate cut backfire? What is your view on global economy and gold, if in case you want to answer, Sumit? That is out of syllabus.
So see, as an investment style, generally we focus on bottom-up businesses, because it's those businesses that create value. Having said that, I believe overall global growth is something that may remain challenged for a length of time. Not necessarily about US only, but many other parts of the world. One of the factor which plays a very important role globally is how is demographics kind of playing out. And many parts of the world is seeing demographics being really adverse for them. Average age of the population is way higher. Either overall population itself is not growing, or it has started to age out. In those scenarios, generally growth rates are low, and which is why we believe that India actually stands at a pretty interesting juncture where we have a young population and um, significantly longer runway for growth. Coming to your question on debt,
Sumit, just
many
I'm interjecting you. Can you pull down this slide so that your face is visible to all of us?
sure,
More clearly, I mean.
yeah,
Yeah,
uh, yes.
yeah,
Is this better?
yeah, yeah.
Yeah. So coming to the fact that many there is a huge amount of borrowings at the in economy level in many parts of the world. Obviously, that's a problem, and many parts of the world need to deal with that, right? And there is no easy solution to that. So that creates an additional uncertainty for global growth.
Okay, great. So now there are some questions that are particularly related to stocks. So uh, one question is related to PI Industries and DV's Lab. What is your view? Are we convinced in holding them? Do you see any concern in these companies, or we continue to hold them?
So see, when we look at performance of most of the chemicals, agrochemicals, pharma chemicals, right? It has been very interesting one. PI industries performance actually has been way better than what it has been for many of the other companies. No doubt, Red Sea crisis may have impacted some bit, but there is a global destocking that is happening in chemical arena. Right? In spite of that, the performance of PI has been pretty decent. And what we believe is PI has got a strength on R&D front. And their relationship with large innovator companies is pretty strong. So their growth over last many years actually has been driven more by agrochemical. Over next few years, we believe that pharma is one area where they are getting into, which will kind of support growth. And also domestic, which has been impacted for not only PI, but in general, industry has been slow. That should also support PI growth. So levers for growth for PI are many, and business performance has been decent, while stock price performance has not been so. So valuations also have become pretty reasonable. So we continue to really hold on to this name. Coming to, yeah.
Yeah, so there is one more question related to sectors, that which are the sectors that are likely to do well over the next 12 to 18 months. You spoke about automobiles, you spoke about many other sectors. Are there any particular sectors which you feel are likely to do well in the near future?
I don't want to comment necessarily about near future. Um, I really
12 to
believe,
18 months, Sumit.
without putting a timeline, I believe uh, India's manufacturing is something that's evolving. Government has tried to give ecosystem to make sure that cost of doing business actually goes down. Huge focus on reducing logistic cost. Um, Also trying to give a framework where there is a policy stability and also incentivizing businesses. So it's only matter of time that manufacturing starts to um, actually see a lot better numbers as compared to what it is at the current point in time. And building that ecosystem actually takes a significantly longer period of time, unlike services, which actually the ecosystem can be brought about relatively faster. It's manufacturing, which is a long period cycle. And when manufacturing does well, the entire ecosystem of capital goods, consumables, logistics, staffing, and multiple other areas which are subset of this actually does well. So I believe this is one area that should do well. Discretionary consumption should do well because there is a huge penetration-led opportunity, a right entrepreneur who actually can build a brand, focus on distribution network, actually can report pretty long period growth. Similarly, whether it is automobile or pharma, we remain positive on many of these areas.
Okay. So your view on capex that is being done by the government, is it sustainable?
I believe not only is it sustainable, it will keep growing. Um, Whether it grows in line with GDP, I mean, today, um, at the current point, even this year, the expectation is government capex will grow 17% higher than what it is, what our nominal GDP growth rates are. And um, overall growth in capex will continue. In fact, we can get into a virtuous cycle when private also starts to fire relatively better.
Okay. So there is one more question. So there are some portfolio stocks in the last 3 months that have done exceedingly well, like Bharti, KEI, and Torrent. Do you foresee that these stocks will continue to retain their momentum, or there was something, some kind of re-rating going on in these counters?
So, see, whether they will maintain momentum in the short period of time, really don't want to get there. But um, let's take each of these business. Bharti, I believe capex has peaked out, and which is why if revenue grows at X%, profits will grow at X plus, and cash flows will grow at X plus plus. So to that extent, way superior cash flow growth as compared to overall revenue compounding. And in general, we have not seen tariff hikes for last almost 2 plus years. It's only a matter of time, given the fact that this industry also has become a lot more consolidated. By and large, it's a two-player industry, right? We may start to see those things only adding on to the profitability, and also significantly more use cases are evolving. Right? Um, Today we are moving towards 5G, and that itself would lead to a lot more use cases, right? So really confident that business should continue to do well. Coming to KEI, it's a beneficiary of how the capex cycle as well will play out. Uh, Today, cable businesses are growing really well. In fact, it's not only about India, but what's happening is there is a infrastructure built out that's happening globally as well. We are seeing fairly decent amount of growth on the cable side from exports. And if you look at KEI, their exports also have actually been really decent. So can this business grow 15% thereabouts for next 3-4 years? Probability is very high. And which is why we believe that we can continue to compound our money there. Third one was Torrent Pharma.
Yeah.
As we just discussed in the presentation, um, are they continuing to grow faster than overall IPM, which is what the overall pharma market has been? They are. In fact, given the kind of cash flows that they generate, um, we believe this company should continue to do some bit smaller acquisitions, and which will only add on to their growth. Um, in fact, that's just part of the story. Um, the kind of cash flows and ROC that they make actually differentiates this company versus many other companies that are there, which are listed. And plus, over and above this, uh, some of the international geographies like US or Germany, which are not yielding them great results at the current juncture, can also turn around. So to that extent, we believe that this business should continue to kind of do really well.
Okay. Now coming on to the dragons like Bajaj Finance, AU Small, APL Apollo, they haven't done well, more specifically between November and January, wherein the benchmark delivered some good returns, very high returns. So any thoughts on these stocks, or it is a just a passing phase for these stocks?
So, see, if I look at Bajaj Finance and AU, there has been some increase in provisions. In spite of that increase in provisions, overall ROE of Bajaj Finance continues to stack up really well. Business continues to grow. In fact, this quarter was in excess of 30%. I believe high growth rate for Bajaj Finance can continue, and which is why we continue. In fact, it's not only about high growth rates. The fact that Bajaj Finance has managed this growth rate with a very superior ROE. ROE is close to about 22 to 24%. It's not easy to do this kind of ROE in a lending business, and that differentiates this versus many of the businesses that are listed out there. At the current point, given the fact that stock has not performed while business continues to stack up really well, it's now available at 20p. Right? So to that extent, we continue to hold on to this name. In case of AU, again, while overall growth rate may have slowed down, the stock got impacted more because of increase in provisions, more with respect to credit cards. Their credit card portfolio actually saw some increase in credit provision that they had to do. This upside increase in normalization is, I think, should stabilize here on. In fact, over period, they have multiple levers to improve their ROE and commensurately ROE. Because most of the new businesses that they are kind of new lines of new products that they have gone into today are loss making. In fact, those things are resulting into almost 20 to 30 basis point impact on their ROE. As they gain scale, we should start to see normalization there. And another lever that AU also has is today they have invested significantly higher for growth. Their cost to income ratios are way higher than what normally should be the case. Right? So over period, we believe their ROEs will increase and consequently their ROEs will also increase. And which is why we kind of are holding on to this name. And third one was APL Apollo. While I discussed briefly in my opening remark, I believe it's the entrepreneurial fire which allows them to kind of, in fact, they're getting into multiple new areas as well. Many of the areas they were not present into, for example, solar power. They'll supply some tubes in solar industry as well. So new use case, right, is also leading to a relatively better volume growth. We believe that from 2.65 million tons that they should do this year, they can be 4.2 to 4.4 million in next 2 years. So volumes will grow well, profits will also grow faster. This quarter was impacted because when steel prices see, or rather when Patra, which is actually see some slowdown, some drop in prices. At that point, we actually see some impact on their volumes. These are more temporary. And when that normalization starts to happen, we start to see pretty normalized volume growth. Year as a whole, their volume growth should be pretty decent.
So Sumit, nowadays there are certain areas of the market that have done exceptionally well. So to give you some names, like if I talk about pure contra funds, pure value funds, small cap space, and the latest to join the bandwagon in the last 18 months or so, PSU. So a lot of questions are there on PSUs that why don't we have this or that, okay? So I am just clubbing all these questions. I just wanted to understand that we at Indian Entrepreneur Portfolio, as the name suggests, are investing only in entrepreneur owned stocks, where the ownership of the entrepreneurs is north of 25%. Now, since as you mentioned in index, 54% is family-owned business, close to 29% is professional, 10 is PSU, and 6 is MNCs. Now we are 100% into family-owned businesses, and we can't move into PSUs. So the natural question that comes to the mind that in the recent past, since there is a lot of money that has been made in PSUs, don't you feel that we have been left out and there is a still lot of opportunity within the PSU space, much better than family-owned businesses? This is the main question that I wanted to raise. Is the opportunity much bigger than PSUs, or PSUs will rule the roost, will continue to rule the roost? Yeah.
Whether PSUs rule the roost or not, uh, entrepreneurs will certainly perform. Uh, History shows that over long period of time, it's that entrepreneurial execution prowess um, that has made a meaningful difference to the business and value creation um, thereafter, right? And with that thought, this portfolio was created. On a relative basis, when other ownership pattern performs the way they have performed, there could be relative differential, but over long period of time, we remain pretty confident how this as a pack will do well. Because for value creation to be a lot more sustainable, it has to be backed by earnings growth over a long period of time, and that earnings growth has to be backed by capital efficiency. And if we kind of get into those businesses, uh, value creation is a derivative. So I don't want to get into, frankly speaking, about this debate where whether it is PSUs or entrepreneurs or, but pretty confident how entrepreneurs does take their business into next orbit, right? And we have seen multiple cases in the past as well, right? Be it in India or be it globally. Having
So,
said that,
hmm,
some PSUs will do well. Certainly, they will do.
hmm,
Um, and some PSUs will backfire. They will, and so would be the case in entrepreneur-owned businesses as well. It's our style always has been that bottom-up investing and identify those right set of businesses, right set of people who are running the show, and create compounding there.
great. I just wanted to have one more question that some of the platform companies that are doing exceptionally well on the bourses like Zomato's. So a lot of questions, around Zomato and why we are not investing in any AI related company. I know most of the answers, but still for the benefit of all, I'm asking you.
So we keep evaluating each of those businesses. And we will get into those businesses when we believe our confidence on their unit economics turning out to be right, right? At that point, we will kind of evaluate those businesses. Some businesses will become large, certainly they will, right? But it's the unit economics that will make difference for one company versus another. And that is where we'll keep focusing on at all points in time.
Okay. Lots of question related to Metropolis. We have currently, I think, 1% or so in the portfolio. Any thoughts on Metropolis? Lots and lots of queries on Metropolis.
Um, See, it's too small a position. In last 6 months, there has been an improvement in the overall environment. Uh, while in the past, pricing was getting impacted, pricing of tests, right? But in last 6 months, what we have seen is test prices have rather started to go up, right? So competitive intensity has reduced pretty meaningfully. And when we look at business diagnostic businesses of Metropolis or the competition, um, overall growth, the base business, which is um, excluding COVID related stuff, right? So non-COVID and B2B or B2C business, right? It is growing about 12 to 14%. So business has started to see normalization, and consequently, stock price also has reacted positively to it. If you look at performance of Metropolis over last 6 to 9 months, it is up almost 40 to 50%, right? And this is in response to the normalization in business, normalization in the competitive intensity, uh, and which is why we have seen this improvement in stock price there.
Okay, now I'm going to ask you the toughest question of all. Okay, yeah, I can understand that this is one of the toughest question. What's the road ahead for IP on the back of underperformance? You clearly mentioned in your presentation that out of 14 calendar years or 14 financial years, 3-4 years we underperformed, and last 2 years, the calendar year calendar year 22 and 23, we underperformed, and because of that, there is a lot of anxiety considering the fact small caps or contra or these PSUs have done exceedingly well. So I understand, and all of us understand that the businesses that we are holding are doing exceedingly well on their operating profits, EPS, top line, and various other parameters. But when it comes to portfolio returns, do you see that the worst is behind us and we are at the end of the tunnel and we will see the light of the day in near future or maybe in next 1 or 2 years?
So see, when you look at performance, no doubt calendar year 22 was a year where there were challenges. Calendar year 23 portfolio gave a decent absolute return. Obviously, relatively, it has been lower than what has been for the benchmark, but it has been a pretty decent absolute return. While most of our portfolio companies have delivered on uh, to the earnings compounding, they also got impacted because of the sharply higher or increase in interest rates, and thereby commensurately increase in cost of capital as well. So when you look at value creation, it significantly lagged the profit compounding. I believe we are at a point where the impact of higher cost of capital or negative impact of higher cost of capital on the portfolio as a whole should not be incrementally there. Portfolio performances of the portfolio companies have been pretty decent. So, which is why our confidence level is really high that it's only a matter of time that we start to recoup those.
Okay, I think with this we will call it a day and we will end the presentation. Thank you again, Sumit, for the detailed thoughts on the portfolio and guiding us which way we are headed for. A sincere thanks to all the participants who took out time and participated in this session. And with that, we will conclude the session for the day. Thanks, everyone.
Thank you everyone for joining in. Thanks a lot.